Okay, welcome back to the podcast. My name is Doug Sandler. Over there, that is Mr. John Browning. Excited to bring you another wonderful episode with a wonderful, fabulous, terrific. Wow, I've built every hyperbole that's in the book.
Wow, that's impressive. Yeah.
That is a lot of our ability to make it so that if you're listening to this, we are bettering your life. We're making your life not just from a financial perspective better, but we're helping you build your best life. And John, I'm excited to chat with you again today about that topic of building their best lives.
Absolutely. Sounds like fun. Let's go.
So I had an interesting conversation just a couple of days ago with my son. He lives in New York. I live in California, and he's 27 years old. He's got a good job. He's had for about a year now. He's had several good jobs before that, but he's finally in a position where he's able to put a couple of dollars away. So we started to walk through some of those things. Okay, how do you take advantage of, the maximizing your savings? So, of course, one of the questions I ask, well, does your employer have a 401k? And
Mhm.
they do. They have a 401k plan. So, I want to talk a little today about 401k and other vehicles that people can get into to maximize their savings for the future. For those of you in our audience that are listening to this could apply to either you if you're in that position that my son is in, or it could apply to your kids, or for you if you're even older and haven't taken advantage of that. So I've given us the platform as the jumping off mechanism, John, and I want you to kind of share some of your thoughts, and then I'll interject in there and help along the way to bring the conversation down to consumer level.
Okay, sounds good. And here's once again, like everybody seems to think, right, that this is an easy question to answer. Should you max out your 401k? And it might not be as straightforward as you think. It sounds great, and a lot of financial advisors out there and individuals just kind of off the cuff say, take the super simple route and say, yes, max out your 401k. Have you made sure that your emergency fund, number one, is fully funded? Would be a first thing. Number two, are all those credit cards paid off?
Mm-hmm.
And number three, you may want to consider, depending on how much you are making, what if you took, instead of maxing out the 401k, what if you contributed to the 401k up to the company match
Mm-hmm.
and then contributed to a Roth instead of the 401k, that you have more control and more flexibility over, and maybe a cheaper way, because people think that the 401k is free. There are fees and charges that those 401k plans charge. It is not free. I don't know any 401k plan that is free. Matter of fact, it is typically more expensive than a financial advisor, or most financial advisors out there.
All right.
So you may want to consider taking some of that maximizing out. But if you are making enough money to both max out the 401k and max out your Roth or your regular IRA contribution, and then there are other ways to contribute to tax advantage programs for retirement as well, then yes, maximize that 401k, but only after those other things are
All right, I want to
checked.
tackle two of those right off the top that I have questions about, and then we'll tackle some of the other ones too before we wrap up today. I know this is going to be an episode that is going to probably open up a lot more questions than we may have time to answer, but that's okay too, because you're going to have access to John and his schedule as soon as we conclude today's episode. So let's talk about two things. One, you mentioned emergency fund. Make sure you have a lot or enough in your emergency fund. What would be your typical advice for somebody to have an emergency fund? How many months or weeks or years of income or should they have in that fund?
So I generally tell people at least 3 months. A lot of other financial advisors say at least 6 months, and I don't think that's a bad idea. Others say 12 months. More than 12 months, I think you can certainly invest more aggressively, and I wouldn't consider that necessarily an emergency fund.
Okay, so somebody has, of course, rent, they have their car payment, they have other things as well. So add all those things up and then just multiply it times the number of months that you want to have, and that becomes your goal for having in your emergency fund. Is that right?
That's right. Yeah, you take your, like I said, your mortgage or rent, and hopefully you don't have a car payment, but I realize some people must have a car payment because it's a fact of life. and for a lot of people. But I would urge you to get the used car. Don't get the nice car just
Right.
until you can afford to buy one with cash. It's a depreciating asset, and you're paying interest on it. Oh my goodness, car loans are horrible, but I understand the need for that in some cases. So any credit card's got to be gone. Even I would say even before an emergency fund, pay
All
off the
right.
credit cards.
All right. All right. So you bring up a great subject. So the question is something like, all right, well, I don't have enough in my emergency fund, or I have this credit card debt that I'm paying 15, 18, in some cases 25% interest. Should I not be putting anything into a savings plan if I have credit card debt until I pay off that credit card?
Unless you can convince me that you're going to make, I mean, guaranteed make 16, 20, 25, and some credit cards charging you 30% right now, then
Right.
you shouldn't be investing anything anywhere. You should be investing in paying off that credit card because that's a guaranteed rate of return equal to what the credit card is charging you. I don't know anywhere you can get even a 15% guaranteed return. And most credit cards today, because those rates have creeped up,
Right.
they're allowed to increase rates. And they've done so up to a lot of credit cards are charging 25 and 30% right now.
Okay, so number of months, that's up to you, but John is saying typical is 3, 4, 5, 6 months and maybe even beyond for your emergency fund. Paying off your credit card debt, really, really important for you to do that. If you're even if you're getting 5 or 6 or 7%, which again is 5% is not unusual today in 2024, in May of 2024 for
Right.
a high yield savings account. But if you're paying 15 or 20 or 30% on your credit card, you really are working backwards. You're going in reverse, even if you're
Going in
putting money
reverse.
in.
Exactly.
Okay.
Exactly. And people will disagree with me on this, but paying off the credit cards even before contributing to your emergency fund, to me, and again, I'll get some hate mail in this one. I would still pay off the credit card because in an absolute emergency, most things you can buy with a credit card right now. And I am just clenching my teeth as
I
I
hear you.
say that. That is
I hear you.
not great. You're not in a great position if that's what you're doing. But and again, one other thing I would reiterate that you said already was emergency fund means not stock market investment. It means like a high yield savings account, money market fund, maybe some short term fixed income instruments or something like that.
Got it. Okay, couple more things in there. I told my son give him whatever best advice that I could have over my 60 years of trying to learn and grow myself. I said if you're contributing to your 401k, only has one direction, and that is in, never out. It never comes, never
Never out.
comes,
Don't take
never.
those loans. Don't do the loans things. I know I hear the arguments like, oh, you can take a loan from your 401k and then you're just paying yourself back. Oh, my
Okay,
sigh.
so you mentioned something about contributing to the 401k, but if you haven't done the emergency fund, let's put credit card debt aside for just a second. You haven't fully maximized your emergency fund. You do have a 401k, you're contributing to that. You may consider putting money in the emergency fund, but continue putting money into the 401k, but maybe just to the point of the employer match because they're giving you free money. So you may as well take advantage of that. Is that right?
Right, right. And each employer is a little bit different as in terms of what their match is. So you've got to pay attention to that and do that math. What makes sense for you. But generally they'll the match is pretty good when you figure out that's a kind of a guaranteed return as well, right? They're giving you extra money if you participate.
And
And
some
there's
of
a
these,
reason. They're not doing that out of the goodness of their heart. There's a reason they do that.
well, it's called employee retention because sometimes you're
Well,
not
it's
fully invested for, it takes 3 to 5 years sometimes to get vested and get that money in return.
that's right. And in addition, the owners of the company and the really highly paid people can only contribute so much if the lower level employees are not participating. So there's some rules there that
Understood.
incentivize
I, I
them to
I can't
offer
I
that.
can't remember what my son's company was paying for him, but I think for every dollar they were actually matching like 40 cents on the dollar. I mean, these startups, it's crazy how
Yeah,
wealthy they are from their the VC funding that they have gotten, and they want to recruit top talent to do what they do. So they pay some ridiculous, wonderful amount, and we appreciate you paying my son extra money for it. But man,
Mhm.
oh man, when I was in the 401k world back in the 90s, it was like 3 cents on the dollar, but it was still 3 cents. It was 3%.
Yeah,
I was happy to get it.
yeah, yeah. That's certainly a great feature, but there is often I often run into, especially in the younger set, where it doesn't make sense to max out the 401k. It's actually better for them if they use other vehicles because they can't afford to max out both.
All right, talk about for just a moment the importance of an individual, single guy, single girl, somebody that's young, or if they have kids that are, that they can provide advice to. Insurance, not insurance. Do you do insurance do you do it as a savings vehicle? Do you do whole life? Do you do term? Like,
Mm.
what do you do at that age, at a young age?
Yeah, so at a young age, if you don't have any dependents, anybody depending on you, a maybe a very small life insurance policy that would cover, like in the event of your death, it would cover, um, you know, your funeral costs and something like that. So you didn't have anybody else having to worry about that. In general, though, I don't really understand why you would do that unless there is one other instance. So, say you're a single person, you bought a house. So you have an emotional need to know that that house is going to go to one of your heirs, maybe your
Hmm.
mom or your dad or somebody else. Then maybe you would want to have life insurance up to the amount of what it would cost to pay off that house. And there's certain life insurance policies that you can get that decline
Hmm.
over time and as your mortgage declines. The other thing that you do want to consider, though, when you're a single person is disability insurance, and so few people
Yeah.
do that. But it is far more common for somebody to become disabled in a car accident, in a mountain biking accident, and whatever, than it is for somebody to die. It actually makes a whole lot more sense that you have disability insurance or long-term care insurance, preferably both.
Mm. Okay, interesting. All
Very few
right.
people do, though.
w-
It's
what other advice can we provide for someone that either has kids or they are a kid or younger and they want to try to figure out, all right, I've got my emergency fund funded, I have my credit card paid off, I'm not, yeah, I'm putting money into some sort of 401k or employer driven plan and I'm maxing that or coming close or at least savings through that. What other vehicles should I be thinking about at this point in my life?
so if you're in that stage where you've got everything fully funded and you have a family, right? This is a family.
It could be. Yeah, I'll take a family. That's fine.
All
I'll
right,
have one.
you can have yourself a family. All right. So so say you've got a family, make sure that you do have that life insurance in that case, right? Because it's really easy to think, oh, it'll never happen to me. And then it does happen to you and your spouse, even if they're not working, by the way, you have kids, who's going to watch the kids? Well, they got to pay for that.
Hmm.
Maybe you were doing that before. Maybe you were watching kids during the day and now they need childcare. I'm gonna just say it. Everybody who has a family really needs life insurance, um, unless you're wildly wealthy.
And
And a
and
lot
then
of other ways you can use
and
life insurance as well. But
and then the choice is what type of insurance, and I think it just depends on where you what your goals are and what your affordability is and what your risk tolerance is and all of the different things that are associated with making those kind of decisions too.
right, I think we did a podcast on term insurance. Is it worth it? But term insurance is frankly more expensive, and people think it's less expensive because it's less cash flow out. It's more expensive in that you get nothing for it until and if you die. Okay, so you've paid all that money in and there's nothing there at the end of it. Still doesn't mean it's not a very useful tool. And if you don't have the cash flow, then don't do it. Do term, right? But if you can't afford it, and in most cases, some combination of term and universal life or whole life typically makes a whole lot more sense in terms of what's cheaper and better for you. But again, all depends on personal situation.
All right, so lots of factors, lots of things to think about. Again, I knew we were going to open up more questions and possibly answer in today's episode. Is there anything that, if I had only one more thing that I needed to tell my listening audience to build their better life, is there anything that we're missing on today's episode?
Oh goodness. If Well, let's go back to the one. So borrowing from your 401k, because I hear this so often.
Yeah.
Yes, you're borrowing from yourself. It's at a reasonable interest rate. Number one, if you lose that job or you want to move to another job, you got to figure out what you're going to do with that loan. You either got to pay it off, or suddenly you get a penalty for not paying it off, and where you're going to get the money. It just becomes a real hassle.
Mm-hmm.
Okay, hassle, first of all. Second of all, it's a bad habit to get into, right? It's just find another way. If I could teach people this art of patience, then that would solve so many problems. You don't.
Delayed gratification is another word for patience in this particular case. Don't
That's
buy
right.
that
That's right.
thing that you can't afford to pay cash for, or God forbid, put it on a credit card and pay 25 or 30%. No, don't do that. Please don't do that. Just wait just a little while longer.
A
You will
little bit
get it. I
longer.
promise you.
Yes, I don't care what you have to do. It's like the only thing I can think of that it would might be where, like, somebody told me one time, well, I borrowed from my 401k because I needed to pay a medical bill. No, 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 no. There are other ways to pay for medical bills that are not borrowing from your 401k. Number one, call your medical care provider. 99.999% of the time, they will work with you under very reasonable terms to get that paid off.
Okay.
And you're neither putting it on a credit card or rating your 401k, which is rating your future best life.
All right. Well, John, we did cover a lot today. I know we're going to have some questions from our community of listeners that want to hear more. What's the best way for them to reach out to you to get more information?
You can text the word life, LIFE, to 321 421 5213. And if you're watching on YouTube, it's right there in the bottom of my screen. Or you go out to guardianrockwealth.com in the contact us section. And I believe there's even a spot where you can click on the phone number. It comes directly to me. If I don't pick up the phone because I'm on the phone with a client or someone else, I will call you back. I've never yet not called somebody back who has a question.
And I know that if you probably wait just a little while, whether it's a few months or a year or so, Scarlett Johansson will actually be picking up through the AI tool.
That's right. Yeah, that's right. I got to
Yeah, the
figure out
whole
how to
thing
make
with
that happen.
Scarlett Johansson and her and she and Open AI and the whole, wow, that's a whole future episode. We could talk. I know we've talked before about AI technology and how that has been affecting the economies recently, but we'll do that on a future episode. That would be a lot of fun.
Let's do it. Yeah, that is fun.
We'll ask Chat GPT. I think we did actually do that in another episode. We'll come back and see what Scarlett has to say. John, thanks for sharing another week with us. Thanks for sharing your expertise.
All right, sounds good. We'll see you next week.